Hello. In this video, we'll be looking at a specific type of debt instrument called held to maturity. We've spoken about the different types of investments a corporation can make, and they can make equity investments or debt investments. And this is one, there are three different types of debt investments a company can make. And the first one is called held to maturity. And that means that the company has the intention and ability to hold that investment till its maturity date. So meaning they want to hold it for the long term. In our previous example that we've been using in the videos is that United purchased bonds that were for 3 years. So they would be considered held to maturity if United had the intent and ability to hold them till maturity. They would be classified as a held to maturity investment and accounted for that way. In a held to maturity, we don't record unrealized gains or holdings and gains or losses. And then the amount that's carried at the balance sheet is the amortized cost, which is we went over through the effective interest method video beforehand. So the net value of that, the net book value at the end of each payment period is their amortized cost value. Another type of investment is a trading security, and that is when a company purchases bonds or notes and they intend to sell it almost immediately, right? It's a very short-term investment. Typically, the longest time period for a trading security is to be held for 3 months, but many times trading securities are held for a few days and maybe even 1 day or a few hours. Any gains or losses, unrealized gains or losses during that time, which we'll go over later, will be recognized in net income as part of the income statement, and which flows into the retained earnings and therefore part of shareholders' equity. It is carried in the balance sheet at fair value. The available for sale debt instrument is classified as anything that's not held as to maturity and not trading security. So if you don't meet any one of those qualifications, then the debt security will be accounted for using the available for sale rules. And in those rules, the unrealized gains and losses are recorded as part of other comprehensive income, and they're carried in the balance sheet at fair value. But let's talk specifically about the held to maturity. And like I said before, it's when the investor has the intent and ability, the positive intent and ability to hold the investment to maturity. So meaning you have a maturity date and you're not planning to sell it before then. These are just terms that we're familiar with. The principal amount is also called the face amount, and that's the amount that is paid to the investor at the end at maturity date. And then we have interest dates, specific interest dates, and specific interest payments that are also paid to the investors. So for held to maturity, which we write out as HTM, we don't recognize any unrealized holdings, gains, and losses. So, which for the other types of debt securities, the trading security and available for sale, we would. So that's why that distinction is made here for the held to maturity investment. But let's just take an example that, let's just say that Masterware bonds that we bought on it on July 1, 27. At the end of the year, on 12/31, the value of it has gone up. It is $714,000. If we were to look at the effective interest method, the amortization schedule, you would see that 12/31/27, the amortized cost, the net book value of the investment is actually $671,297. And this is telling you, so that's what it is on our balance sheet. What this is telling you is that on the open market, this bond is worth $714,000. So obviously there's been a huge gain for whatever reason. So the question is, do we record this gain in any kind of way? And the answer is when you have investment that you intend to hold, any sort of fluctuation in the gain, whether it's gains or losses, while you're holding it, is considered to be, not relevant to the face of the financials, because as a company, we're intending to hold it to maturity, so those gains and losses won't really affect us. However, we do need to disclose that in the notes to the financials, that fair value. So we would disclose that 714,000, just so the users of the financial statement know that the value has gone up, but it doesn't need to be on the actual financial statement, on the actual income statement itself. And so we are not going to recognize any sort of fair value changes on the income statement or the balance sheet for the held to maturity investment. The only exception to that is if there's an impairment to that investment. And think of an impairment similar to when we did accounts receivable and we did the allowance for doubtful accounts. Because if we have accounts receivable on our books and we think some of it is not going to be collectible, we record an allowance for doubtful accounts. If for some reason we think that we won't be able to receive the principal payment or some of the interest payments from what's it called, Masterware in our example, then we would need to create an allowance for credit losses and net it with our investment account on the balance sheet. So we would have our investment account at whatever the amortized cost is, less this allowance for credit losses. And so then we would have this net investment number on the balance sheet to show the reader that this is actually what the true number that we expect to receive at the end of at maturity, on the maturity date. But this is not the typical, this is just if there's an impairment. So what happens when we sell held to maturity investment? Let's go back to our example where Masterware Industries sold a $700,000 bond at 12% dated July 1, 2027. There's interest payments of $42,000 made twice a year, and the bonds mature in 3 years on June 30th, 2030. We have accounted for this investment as a held to maturity because when we purchased it on July 1, 2027, our full intent and ability was to hold it for 3 years. But due to unforeseen circumstances, the company decided to sell its debt investment for $725,000 on January 5th, 2028. So for whatever reason, we've sold it. So here's the entry that we will make. First, we sold it, so we received cash for the $725,000. So we debit cash $725,000. Next, let's look at the investment in bonds. The investment account, when we originally recorded it on July 1, was we did debit for investment in bonds for the face value for $700,000. That's what we did on July 1st. So now we're going to credit that same account, investment in bonds, $700,000. The next is we have a discount on the bond that we originally recorded. And if we're going to look at the amortization schedule, right, we're going to look at right here, this, I'm going to draw a line. And because in the previous slide, we sold it on January 5th, 2028. So we need to look at, here's our discount balance on our balance sheet right now at 12/31/2027. And so that's sitting there at a credit balance of $28,703. So we would need to debit our discount for $28,703 and then we have a gain on investment. We have a credit, an actual recognized gain for $53,703, and that is recognized in the net income. I also just want to go and show you an alternative way you can calculate this as well. Is we know we got $725,000 cash. We know we have to credit our investment bonds for $700,000. You could also just calculate the gain on the investment and then plug the discount. And the way we calculate the gain is it says we sold it for $725, and so we would take our $725 minus our carrying value of the investment on our books. So we would take $725, which is our sales price, right? Minus the cost that is on our books. And we would look at 12/31/27. The latest one that we have is 671,297. And the difference between that is going to be your 53,703. 703. And so that would be your gain. So you could do that, and then you could record your gain, and then your plug could be to the discount. Or you could do one or the other and double check it that's correct. Have a it's a sort of a double check. So let's just talk about the financial statement presentation for the held to maturity. We don't do anything for OCI, other comprehensive income. Additionally, for held to maturity, any unrealized holding gains, which would be truing up our investment to fair value before we've sold it, would be an unrealized holding gain or loss. We don't record that on the income statement or balance sheet. We just disclose it in the notes. We do recognize a gain or loss depending on how much we get for it. If we sell it before maturity or at maturity, we do realize gain or loss on the income statement as part of net income in the period in which they are sold. So that's kind of the income statement and statement of comprehensive income presentation. On the balance sheet, the investment in the held to maturity are reported at amortized cost, less any allowances for credit losses, which should be not typical. But the fair values of the investment are, again, they're just disclosed in the financial statements. On the statement of cash flows, when we buy and sell the held to maturity securities, they're typically in the investing activities section of it. Let's just look for this particular example that we've been going through, the presentation of all those financial statements for 2027 and 2028. And remember, this is when we sold it on January 5th, 2028, we sold this investment, but we purchased it on 7/1/2027. So for 2027, we recognize the first 6 months of interest revenue for $46,664. So that's part of our net income. Then we had our amortized cost, our net investment in bonds was the $671,000. That's because we recognized a little bit of the discount for the first 6-month payment. Our retained earnings for the year comes down straight from the net income. And on our statement of cash flows, we had interest payment that we received, and that would go under the operating activities. And under the investing activities, we would recognize when we purchased the investment at the discount price of $666,000. Then for 2028, right, because we sold it on January 5th, we did not receive a second interest payment. And so therefore, we don't have any cash received from interest on the statement of cash flow, nor do we have any interest revenue to record in 2028 because our next payment would have been June 30th after we sold it. So, but we do have a gain on the sale of an investment for the $53,000. So that would go into our other income expense section of the income statement. and that would actually go down and get added to the retained earnings. So you take your retained earnings, the 46,000 from the prior year plus the 53,703, and you get retained earnings of 100,367. And also you sold those securities, and so that would be cash inflow of 725,000, and you would report that on your statement of cash flow under the investing activities. Let's do a concept check. Williams issued a 600,000 of 10% bond dated July 1. Interest is paid semi-annually on June 30th and December 31. The bonds mature in 10 years. And the market interest rate for those bonds when they were purchased was 12%. The entire bond was purchased by Joe Inc., and they decided to sell them due to unforeseen circumstances for $550,000 on January 1, 2028, at which time the bonds have an amortized cost of $580,000. So the question is, what when you make this journal entry, what would it include? Well, when we purchased the bonds, the investment, right, when we recorded the investment on July 1, we would have debited investment in investment for $600,000. So when we sell it, we're going to credit investment to $600,000. So I know that C is going to be my answer. But let's look at the entire journal entry. So we have here, we know that we have investment in bonds for $600,000. We're told that the company decided to sell the investment for $550,000, so they received cash for $550,000. We are also told that on January 1, 2028, the bonds have an unamortized cost of $580,000. So they have an unamortized cost of $580,000. They need to go up to $600,000, right, eventually, which means that our discount on the bond, account has a credit balance of $20,000 remaining. That's how we would have eventually gone the investment balance to go up to $600,000 over time. But since we have a $20,000 credit, we need to debit discount on bond for $20,000, and therefore our plug is a loss on investment of sale for $30,000.